I'm going to talk today about the coming bond crisis and what this means. Now, when I talk about bonds, I'm talking about not just government, but also corporate bonds. And where I see, even though the government bonds, especially in Europe, have got major problems coming forward, which I'll deal in another video, the real pressing problem at the moment is the private bond sector, commercial bonds. And you will see as this crisis plays out how liquidity, or rather illiquidity, of these bonds will play a major factor in what I see as a financial meltdown. Now, I know that stocks are going up and stocks will go down, etc. like that, but really what happened in 2007 was not necessarily a stock market crash, a stock market correction. It was a complete liquidity crash where basically the banks and fluidity of credit just dried up. So I think it's really important to look at what's underlying the market, and bonds are part of it, not all of it. Now, as we've seen at the moment, the US and the EU are tapering. What does tapering mean? Tapering means that they're no longer printing money on demand effectively by issuing bonds. What they're doing is that they're actually taking money out of the system now, and they're not printing anymore. And what this is causing a dry up of the cheap, easy money that we've seen since really the crisis, and especially since the European crisis in 2011. Now, why does this matter? Well, it does matter because, say for example, the 10-year Treasury bond, those rates fix things like mortgages, car loans, etc. So as they start to rise, what you start finding is you start to find creditors who barely can get by on debtors rather, who can barely get by on 0% to 1%. When those rates go to 3 to 5%, then you really start to see stretch problems. So as these rates go up, so does the potential of default. And this is what I'm going to talk about a bit later on in the video. Now, we have a central bank conundrum because, you see, at the end of the day, the central banks need to have the inflation. Why? Because through inflation, the massive foreign debts can be liquidated, as it were, because it effectively spreads the cost in a shorter time period. So, as you can see, the central banks have been desperately trying to create inflation, and it's been unsuccessful, and in later videos I can explain why that's been unsuccessful. Now, when we're talking about bonds, I mentioned about the private sector versus the corporate, the government sector. Now, the private sector is really, really important because in the private sector we have really two types of bonds that are prevalent. We have junk bonds and we have investment grade bonds. Now, we also have another area of deep concern is leveraged loans. Leveraged loans are basically those loans that corporates go to the market for because they can't issue bonds, BBB. Junk bonds is BBB or less. So they can't go to the market for bonds, and because they just don't have the fundamentals to do so. So they tend to pay higher rates, but they also have, with higher rates, there's a much greater risk of default. And the leveraged loan market, in my opinion, is very, very, very similar to the subprime market that existed in 2007. And some of the junk bonds, BBB rated, are in a similar situation. So if we start seeing fallen angels, which are companies in the BBB plus category, starting to have serious problems, then we start seeing them go down to the leveraged loan basis, which weren't previously rated to do that. So there's a blowback for the economy in terms of potential liquidity problems as these corporations struggle for finance and potentially fail. And therefore, if any of them are financial institutions, then we are faced with a potential Lehman moment, which is really, really, really scary. Now, let's talk back again about the Fed and its buyback situation. Let's put some figures on this. Now, back in January, before the real aggressive buyback occurred, there was about 2.46 trillion outstanding in US Treasury bonds, and this is as of October 2018, we're now talking about 2.29 trillion. So we've seen almost 10% of that portfolio liquidated. So that means we've had 200 odd billion taken out of the market. And so that's less liquidity and that's less cheap money that the market has to do. So that can't be reinvested in stocks, it can't be reinvested in real estate. So we're now starting to see almost a credit squeeze on that. Now you start to compile that on top of the economic cycle, and where a lot of other sectors are starting to get stretched in a credit sense. We're starting to get very, very worrying signals, potentially worse than 2007, because the bond market is extremely important as far as liquidity is concerned, extremely important as far as governments funding their deficits, that it cannot be ignored. Now, also, because not only have we seen the liquidity being withdrawn, we've seen a more aggressive Fed raising the interest rates on a 0.25% just recently this month. So we've seen interest rates of January at 2.55%, now at 3.25%. But just because the base rate is 3.25% doesn't mean to say that that's what the lenders are going to lend to you and I, the general public. There's always a credit spread. And this credit spread is now starting to increase, because risk, as I've mentioned before in the previous video, risk has not been subsequently priced properly in this market, simply because there's been so much cheap money. Now that this cheap money is being taken back, what we're finding is that risk is now starting to be repriced. And I'll be honest, we're talking about October the 12th at the moment. October the 11th at the moment, sorry. And what we're seeing is that the stock market on October the 10th took a nearly 1,000-point dive. Well, this is because risk is now starting to be repriced, because the injection of cheap money is no longer available at the scale that it once was. And so this is really important. So there has to be a correction somewhere. And I believe that the stock market correction is symptomatic of some form of risk being repriced. Now, this is all well and good, but what does it mean? If we have a look at this particular slide, that we can actually see that there is now a huge change in global liquidity. We can see on the right-hand side where there is a definite decrease in the liquidity. So, and this is from Morgan Stanley research. So, main researchers are now starting to find that there's anomalies in the system, there's anomalies in the pricing, and we all suffer to some extent from normalcy bias. Normalcy bias is where we go along with the herd mentality. And there are starting to be signals that things aren't as good in the bond market as they could be. And this is really quite a concerning worry, especially for me. Now, I have a pictorial here that basically shows the potential bond bubble that's going to occur. Now, I've broken it up to BBB. Is the junk bond rating, or below that, and we can see that there's 2.6 trillion in the junk bond rating. Now, what we're looking at in this side of things is the high yield. The high yield is also in the red. The high yield and the junk bond BBB rating is making over 50% of the bond market. Well, why is the high yield of significance? Well, part of it's of really, really important significance, because with depressed yields via quantitative easing, printing of money, etc. like that, it's been very, very, very hard for insurance companies, banks, investment companies, pension funds to make money for their clients to pay future entitlements. So there's been yield chasing. And what this has done is that this has meant that the actual amount of yield that investors are prepared to wear, because they've ignored risk. Now, I'm not saying that this is the case, but there probably is a preponderance, and there's been some articles, especially in Bloomberg and Money Watch, that have referred to that credit agencies not necessarily have turned a blind eye, but they're possibly not categorizing risk in the categories of the bonds, because there is such a pressure to chase yields. And this is where it's so like the subprime crisis, because when you chase yields, generally in a low yield environment, then the appreciation of risk suffers. It's when there's a moment of truth then yield snaps back. That's why in a market that corrects, you see a vertical decline as opposed to a gradual increase in investments. Now, so what there's a potential is that this high yield debt, which is 1.3 trillion at the moment, which is a huge amount. It's actually much more than what there was in the 2007 crisis, is probably a much larger figure, because there is a potential, as it were, not pressure, but likelihood of not really risk pricing these bonds, risk categorizing these bonds correctly. So you don't necessarily need a large change. Now, if a company goes from a BBB down to high leverage, down to high yield, and then potentially to leverage debt, that's a really, really bad sign of a liquidity crisis coming, because basically what it means is that the risk profile of those companies and in those bonds has been completely and utterly mispriced. And what we're going to see, not so many fallen angels, but as people who can't meet their debentures, can't meet their loans to banks, etc., like that. And all you need is a big company going down, and we're back in a Lehman moment. And so the bond market is one of the players, but it's a major player that you've got to be careful of, because if the bond market freezes up, then we have a major liquidity crisis. Now, when we talk about investment grade, we also talk about, these are the ones that are AAA down to triple B. These are usually safe bets, if you want to call it that, and usually the yields are lower. But the interesting thing is that the actual spread between the investment grade and the high yield and leveraged debt doesn't compensate at all for the risk. So, a couple of things to note about this: that the outstanding junk bond yields exceed by 50% the entire size of the investment market at the peak, just before the crisis of 2007. So all these pundits saying, there's nothing to worry about, people are making their commitments, etc., like that. But for how long? And here's the thing to consider. And this is why I touched about the treasury bonds, with the yields going up, there comes a switching point, an anchor point, where the risk doesn't compensate for having bonds or buying back shares. Because if, say, for example, you're paying a 4% dividend and your bond rate, the treasury bond at 4%, then basically you're much better not buying shares. You're not better not buying dividends. So what you're paying dividends. So what you're doing is that you're shifting buybacks of shares back into the bond market, which fuels the debt even more. So what we're going to start seeing is the share market actually starting to depress as this pivot occurs. But when the pivot ends, then all hell will technically break out, because it's just a money transfer at the moment, and what we're seeing is potentially a correction and a money transfer. When that particular shift ends and that risk is priced in, then we're going to start seeing liquidity problems. Now, in 2000, the junk bond market, BBB, leveraged loans, etc., represented 30% of the market. Those combined today represent in excess of 65%. So again, another factor in terms of the huge volume of bonds is a potential worry. Now, when we're talking about net leverage as well, net leverage is a very good indicator of risk assessment. In the year 2000, we had a net leverage ratio of all the bonds, the junk bonds and the other ones, the leveraged loans and high yield bonds. The ratio was 1.9. Today, the ratio was 1.7. Today, the ratio is 2.9. We're seeing a 50% ignorance, as it were, of the risk that the net leverage has skyrocketed. This is why I went back to the example of the credit reference agencies and not necessarily taking this into account, and hence the relationship to the subprime crisis of 2007. Everything is stretched. Everything has been the concept of risk has been destroyed for almost a generation, for 10 years. Now, as these central banks are tapering back, these stretches are now starting to overstretch, and we're going to start seeing major pressure in the bond market, especially in the lower end. And as fallen angels turn into defaults, we're actually going to start seeing a real mess. And if you don't believe that this is happening, look at China, which we're going to deal with later. There are so many onshore defaults there at the moment from not being able to make their obligations through wealth management plans. Wow, you know, it's just incredible that this is all being ignored. So what does this mean for you? Well, basically, yields. Let's talk about yields. BBB yields in October 2008 were 10.17%. They're now at 4.57%. T-bonds, the 10 years are at 3.25%, and in 2011, 2012 they were 1.4%. Not going to be much until they're 3 times that level. So as the Fed starts tapering more, etc., like that, withdrawing more liquidity, and those yield rates go up, and therefore other interest rates go up, the recipe for starting to stall the world economy, not just the US economy, is definitely there. But my thesis is that there are so many crises going on of which bonds and liquidity are part of it. We're going to have a liquidity crash. And think about it like this. It didn't take much except fear for Greece 2 years ago for their internal bond market to literally completely collapse with the ECU, the European Central Bank, the European Central Bank having to come in, bail out Greece again. But what was frightening about Greece is that the citizens of Greece could only take out 60 euros a day. Can you live on 60 euros a day? Don't think that this can't happen to you. When there's a bond crisis, when there's a liquidity crisis, when there's a currency crisis or crash, this is the next phase. So why am I really scared? Why am I really scared? Okay, let's just look at the CCC rated, which is the leveraged debt, below leveraged debt, etc. It's the bonds that are high yield bonds, effectively. At their peak during the crisis, their yields went to 45.2%. Yes, 45.2%. Well, what are the rates today? Well, before we go to the rates, during the fracking crisis, those rates spiked again to 21.54%. Okay? And a lot of oil producers nearly went out of business. Luckily, the price of oil went up in the ensuing period of 2 years ago to cover many of the losses and the hedging and the bank debt that was issued to those particular energy providers. Now, where do you think that the CCC bonds are at the moment? 9.9%. Wow, that is not even, that's 1/5 almost of what they were. You can't tell me that as soon as a crisis hits, as soon as liquidity crisis hits, that this sector of CCC bonds and the investment grade bonds, which are going to dwarf Lehman's, we're talking about 2.5 to 3 trillion of liquidity problems, isn't going to hit. So watch out for the junk bond side of things. Yes, you can get great yields now, but great yields have got they're great yields because of risk, but they're only great yields because risk has been mispriced. Once risk comes back into the market, it doesn't matter how much your yield is on a company that's gone broke. And you can't sell into a market that's depressing a bad bond. You know, you just cannot. Nobody's going to be there to buy something that's going broke and broke really quickly. So one of the things is keep an eye on this bond market, because the bond market is also a very good signal of what is coming down the chute. And there are so many things, and I hate to be negative, because there are buying opportunities in all this, but you have to know what's going on so as you can plan your portfolio for the future. Thank you so much indeed for listening to this video and watching the video, and I will see you in the next one. Thank you. Bye.